Hello and a warm welcome to Econoday Unplugged on Wednesday, the 29th of September 2021. Terry Sheehan is on the US East Coast, Brian Jackson's in Sydney, and I'm delighted to say a new voice on the podcast today. Max Sato joins us from Toronto. I'm Jeremy Hawkins in London. So, after all the central bank activity, or in some cases inactivity last week, this week was supposed to have a slightly quieter feel to it. However, in Asia, markets are still looking nervously at Evergrande's financial woes, and Japan is about to get a new prime minister. In the US, a barely plausible debt default draws ever nearer, and combined with still building global inflation pressures and Fed tapering talk, that's led to a sharp spike in Treasury yields, which in turn has lifted the dollar to its highest level in round about a year. Knock-on effects are pushing up borrowing costs in Europe, and that won't sit at all well with an ECB that remains heavily focused on maintaining favourable financing conditions. In addition, Germany's just had an inconclusive federal election that leaves both the centre-right and the centre-left in with a chance of forming the next government. And the outcome here could be crucial to Germany's own debt brake, as well as more generally the rules that set the limits on Eurozone government borrowing. So there's clearly a lot going on. Right, let's get the ball rolling with Brian, and if we can, China. So, Brian, since you were last on the podcast, we've had what? Chinese government making cryptocurrencies legal, further signs of slowing domestic growth, and of course, last week, all the kerfuffle surrounding China's largest issuer of high-yield dollar-denominated bonds, Evergrande, when it failed to make Thursday's bond payments. Forecasters revising down their Chinese GDP forecast. So, how important do you think Evergrande is to policy, and what chance now that the PBOC could cut interest rates at some point?
Yeah, not a lot going on. Well, the Evergrande story is a big story, no doubt, and it's hard to predict exactly how it's going to play out. But we seem to be getting a bit of an idea this week with reports suggesting that the government is leaning on some government-backed property developments, other asset management firms to sort of take on some of the assets from Evergrande to sort of help fix its balance sheet. Just in the last 24 hours, we've had news that Shenzhen Bank is going to take on a pretty large stake, offloading some of its property projects to other firms, trying to perhaps share the load of some of these problem assets. So that could be one way that we sort of put a band-aid on the problem and sort of muddle on through. But of course, what it's going to do is, I think, just going forward, we are going to see people put on a bit more of a risk premium for the whole sector, raise borrowing costs, and perhaps slow this sector down a little bit. And that's perhaps something that policymakers would actually like to see happen, because again, it's not a huge surprise that we have had a problem in this area, because we've known for a very long time that the Chinese economy has been unhealthily reliant on the property market and real estate speculation. Every time, basically over the last 20 years, growth looks like it's slowing a little bit. The Beijing says, okay, well, let's just build some apartments somewhere to try and boost the numbers, and over time that's just sort of built to be not sustainable. And I think policymakers are sort of moving in that direction as well.
Okay, yeah. I mean, as you say, clearly the residential side has been instrumental in the growth we've had in the Chinese economy for such a long time now. So, if we see a real hit coming to the residential sector, previously on the podcast, you talked about Chinese economy starting to show signs of slowing. Is that going to be enough, do you think, to actually make the People's Bank of China really come out and ease? And indeed, just looking at some of the stories doing the wires at the moment, there's even some speculation about the possibility of a renminbi yuan devaluation. Do you think that's plausible?
Well, yeah, it is. I mean, they will ease policy if things slow down too much, definitely, and they've got a few policy tools at their disposal. So they can tinker around with bank liquidity. They can lower reserve requirements again.
Mm-hmm.
But as you said, probably the currency issue policy response is sort of not one that they go to most regularly, but that's sort of at the back of the toolkit as well that they could use. So they will make adjustments if we see a continued slowdown in the economy. But again, they are probably looking to try and shift the mix to a certain extent to try and make it more sustainable. And so perhaps they're not targeting the same levels of growth that they have in the past. And so that might make them a little bit more comfortable if we do see growth slow down a little bit from some of the previous sort of normal levels, if they think it's more sustainable. And it's not just the property market that's sort of weighing on the growth outlook. It's other decisions that Beijing is making. In particular, over the last couple of weeks, we've seen a lot of investment banks cut their growth forecast this year, specifically in response to what Beijing is doing on the energy front. So, obviously we've got increasing pressure on China to cut emissions, and so they've announced some pretty ambitious targets to cut energy consumption, energy intensity in some of its industries. And so that's probably another factor that is weighing on growth. And it sort of, again, highlights the issue that they might be prepared to actually see a lower average rate of growth going forward than they have in the past.
Okay, just quickly on, shall we'll get what the PMI's out later on this evening, won't we? Do you know what's expected
We do,
on
yeah.
those?
So we start to get the Asia PMIs later on today with China, and then obviously the rest of the region over the next week or so. And so they've been sort of trending lower in China for the last 3 or 4 months. And so I think the risk is that we're going to see another sort of pretty weak set of PMI numbers for China this month.
Okay, great. Let's move across literally your neck of the woods of Australia. RBA has already warned of a sizable contraction in third quarter GDP. And we've had, a weak August employment report, 3 consecutive falls in retail sales, which I guess is pretty well in line with their assessment. So any thoughts on just how bad the third quarter will be, what the chances are of recovery in the fourth quarter, and indeed, bottom line, I guess, what's the RBA going to do next week?
Well, I think the RBA will keep rates on hold next week.
That's a done deal, is it?
I think so. I mean, they've been very clear that they don't see any prospect of a move in policy rates for quite some time until inflation picks up, and then that's going to take a stronger labour market. So they'll talk again about their asset purchase program probably. They've started to scale that back this month, so they'll talk a little bit about that. But rate hikes are off the table for the time being. But it basically again is a response to what's happening in the economy, and that's obviously being driven by the COVID outbreaks that we've had here in Australia over the last few months and the public health restrictions. So
how's the lockdown?
The Q3 contraction in GDP is sort of baked in the cake now, and everyone's sort of not going to be surprised when that happens.
Okay, so how's the lockdowns going? Are they being eased now? Or do you still have serious lockdowns?
No, they're still in place. So, Victoria and New South Wales, the 2 most populous states in Australia, are still under pretty severe lockdown. That's been the case for about 3 months now. But the good news is that we are seeing some light at the end of the tunnel, at least in New South Wales. The authorities there have indicated that they're going to start easing restrictions in, say, 2 or 3 weeks' time from now, in response to the increased vaccination coverage here in Australia. So, lots of talk about a pretty notable easing in restrictions in 2 or 3 weeks' time, and then so the clear expectation is that then that will result in a pretty strong rebound in economic activity, and that's been the message from the RBA all along. That obviously they're concerned about the short-term impact on growth of these lockdowns, but they're not too worried about the long-term impact because they expect the economy to bounce back pretty quickly once the restrictions are eased.
Okay, well, one of the most hawkish sounding central banks of recent times, perhaps putting South Korea on one side, has been the RBNZ. Clearly, they didn't do anything last time because of the COVID issues. What's the expectation there for next week? Will they pull the plug now, or are we still going to stand steady?
No, well, I think the clear consensus expectation now is that they will go 25 basis points next week. I mean, as you said, they were almost ready to go last month, and I think they were literally about to press the button when they had an outbreak in New Zealand, and a pretty swift lockdown by the government. So if that hadn't have happened, we would have already had probably an increase. Now that they've had a month to sort of digest that, sort of see that things, hopefully aren't going to be too bad there. I think they're going to be ready to go next week. We've had officials from the RBNZ about, I think it was last week, just talking about, well, he was asked, do you think they'll go by 50 basis points? He didn't say, he said, well, no, we won't go by 50 basis points. We'll either keep on hold or go by 25 basis points. But the clear implication of that is that, they are considering a 25 basis point rate hike next week.
Rates going up. Also from countries you cover, the RBI, India, I guess no changes expected there. Next Thursday, isn't it?
Yeah, that's right. I think, they're still not too concerned about the inflation outlook and still very much focused on, on what's happened to growth over the last 6 months. So I don't think there's any urgency for them to move rates there.
Right. Okay, excellent. Thanks for that, Brian. Anything else you want to say before we move along?
No, I mean, just obviously keep an eye out on the PMIs over the next week or so and see.
Okay, well, I think we might have lost.
If there are any, bump the numbers around.
Okay, great.
Yeah,
thanks for that.
Keep an eye on some of those PMI numbers.
Brilliant. Thanks, Brian. Okay, Max, Japan. If I can get the name right, Fumio Kishida looks like to be the next Japanese Prime Minister. Does that have any implications whatsoever for what's going to happen to Japanese economic policy?
I don't think so. I think the LDP, the ruling party, actually picked the safest and most stable person to lead the party and the country, at least until through this lower house election campaign period, and then into the next year's upper house election. You see, the Bank of Japan has been trying more than 8 years to reflate the economy, but they have acknowledged that mindset among most of the companies and households, it's still, they haven't really recovered from years of deflation. So people don't think prices are going to go up, so they're going to wait till later. They're not in a great hurry to buy stuff or borrow money. And even when the government puts together another stimulus package, pumping money into the system, you have to have a new type of supply to meet changing demand, lifestyles demands. So in a nutshell, we don't see any change to the monetary policy stance. The target is 2% inflation, but even Governor Crowther said it's not going to happen while, he's in office for the second term. And fiscal policy, people seem to be less worried about balancing the budget, so they'll probably keep putting together more stimulus packages. But the real challenge is they can keep doing that, but unless somebody stands up and says, okay, we have to really reform the pension system, public pension system, which means people are going to get paid less when they retire, and they have to probably pay into the system more. And also the medical system, doctors are big pressure groups. So they've been promising, the ruling parties have been promising to do something, but we haven't seen anything significant on those issues.
Okay. Let me ask quickly about the exchange rate. Looking at dollar yen, we're trading as we record this podcast around about 112 now. So we're basically back to the high we had just before the pandemic hit last year. To the extent that the BOJ has been struggling for so long to try and get inflation up, I guess they will actually come out and say, obviously, they've got anything like an exchange rate target. But are they going to be happy with the fact that the dollar is as strong against the yen as it is at the moment?
They're pretty comfortable with the current range. They have a wide range, and I think anybody would agree among the BOJ people and the government that if the dollar goes below 100, that's definitely a danger zone, not comfortable. So, but then, they have to coordinate with the US, obviously, and Europe. So I don't expect any intervention right away as we get, as the dollar even backs down towards 100. But right now, it's in a comfortable range. But at the same time, we have seen lower yen didn't really help Japanese exports in volume. Just it's just the depreciation of the yen just does help Japanese companies to compete with their prices overseas. But right now, I don't think the currency exchange rate is an issue.
Okay, great, excellent. Thanks for that, Max. Right, let me move a little bit south of you to Terry. So, Terry, Jay Powell appears to have made next week's US employment report one of the most important data releases in some time. So what's going to be the key to tapering? And in fact, has there been any comment from Fed officials about this sharp rally we've had in US Treasury yields?
Nope. Policymakers have generally been pretty quiet on it. Short-term moves is something they don't like to comment on, and whether it's going to be short-term or not is yet to be determined. Right now, they're very much looking at the employment report. As you said, Jay Powell has been far more specific about the conditions under which the taper will start than I ever remember any Fed chair being. But early forecasts are looking toward the soft side. And I think that we'd have to see an increase in non-farm payrolls on the order of 500,000 in the next report in order for them to taper.
So if we get a 250, for example, there's no tapering.
I would, what the Fed policymakers will look at is the average for the quarter. So the monthly gain on average. But it would take something on the order of 500,000 or better to keep it at a level that would be what Powell has called the all but met level of employment.
Right. Can I just play devil's advocate here? Just for a bit of fun. Let's suppose we get a really weak non-farm payroll next Friday, but we see the offset coming through in the previous 2 months' revisions. So the net of the 3 months is kind of enough. Would that trigger the tapering, or is the fact that the latest month's so weak? Okay, it would.
Yeah, if they continue to get something on the order of 600,000 per month, they will taper.
Okay. And is it all about the payroll, or should we be interested in anything else in this report?
Well, of course, we should be interested in everything in the report, but it really is the payroll number that's probably going to be the real determinant here. I mean, I think they can reasonably expect to continue to see rising wages, and they may see some decreases in hours worked because there are some signs of slowing in the U.S. economy in September. But I really think it's going to be the non-farm payroll number that's going to be critical.
Okay, roll on Friday week. That's going to be a humdinger, isn't it? All right then. As you have talked about on previous podcasts, seems like every podcast at the moment, good old debt limits. As this deadline draws ever nearer, have we got any key dates we should be focusing upon now? Should be in our diaries to keep an eye open for?
Well, Secretary Yellen has put a date of October 18th, more or less, on when the U.S. Treasury will have no more borrowing capacity under the current debt limit. So we've got little over 3 weeks before that happens. And in the meantime, of course, Congress is trying to get its budget in order. And if they don't pass some resolutions today or tomorrow, we're facing also the possibility of a government shutdown. So there's a lot going on in the background against Fed's monetary policy. we'll see what happens. But it's...
Do you think investors have actually taken on the real possibility of a default? I mean, because we go through this rigmarole, it seems like, every year the markets become so, oh, here we go again kind of thing, so complacent about it. Is there more of a risk this time round, or is it just pretty well just a repeat of what we've seen before?
I think there's a real risk. I think that the level of intransigence is such that people may talk themselves into a corner and be unwilling to talk themselves out again. I personally am very concerned. I know that there has been previously a lot of planning on what to do if, in fact, the government gets, or the Treasury gets to the point where the debt limit has been reached and there is no more wiggle room under it. So I know they have plans in place. The problem is that it doesn't change, that it puts the US in danger of default.
All right, still watch this space then. Now, look, with apologies to Oscar Wilde, one might say that to lose one regional Fed president may be regarded as a misfortune, but to lose two looks like carelessness. So we got both Boston and Dallas looking for new head honchos next month. So what's going on? And crucially, of course, for financial markets, does their early retirement or departure have any implications for Fed policy?
At the moment, no. Neither of the two district bank presidents are in the voting rotation for the FOMC this time around, so their absence won't change anything in regard to the vote. But it does in terms of changing the dynamic of the FOMC. The first vice presidents of the respective banks will represent the banks at the meeting. So again, it won't change anything in the immediate future, but the search for a district bank president can take some months. Mm-hmm. And in the case of Rosengren, he would have been a voter next year. So whomever takes over for Boston will be a voter next year. So that could have some implications for the outlook for monetary policy.
All right, interesting. Anything else from your side you'd like to put into the pot?
Well, the only other thing is Elizabeth Warren, Senator Elizabeth Warren, has come out with some pretty harsh criticism of Chair Powell, and that she would not support him to have another term as chair. She's only one senator, but she is on the Senate Banking Committee, and it does suggest that Biden might not get the support for Powell that he would want if he were to renominate him. So it does suggest that Powell's position is a little shakier in that regard.
And that would be interesting at a time when the Fed is supposed to be starting to taper, if not raise interest rates. Fascinating times. Okay, Terry, thanks muchly for that. Right, let's just quickly stay with North America and go back to Max. Canada. Max, July looks to have been a pretty poor month as far as the Canadian economy is concerned, and that was after the Bank of Canada was far too optimistic about second quarter growth. So have things improved since then, and what's the latest view in terms of the next round of BOC tapering?
I think they're going to be cautious and sort of in step with the Fed. They always watch what the Fed does because they don't want to have a huge implication on the currency rate. But I think the governor of Bank of Canada is sort of downplaying the unexpected slump in the previous quarter, saying this is basically because globally we have shortages of chips and other materials, so the companies cannot produce enough cars and appliances and parts, so that hit the production and exports. So that seems to be the theme globally. But at the same time, there's a fine balance between reopening of the economy and some restrictions again because of the resurgence in August. And if you take a look at the sources of parts coming to North America or Japan, Southeast Asia, for example, Toyota said they have to see a lower production because lockdowns in Vietnam and still problem in Malaysia. They're cutting the supply, and that's we have the same problem globally. And looking at the consumer sentiment, I think many people are not happy with the liberals. Trudeau calling the election, and the result was basically almost the same as before.
Right,
so
yeah.
what was the point of spending $600 million to hold this election?
Yeah, I think there's a lot to do with politics. People feel like that at the moment. Okay, just a quick one before we finish on Canada. How important is FOMC policy to what the BOC does?
Sorry, what's that again?
Sorry, how important is what the Fed does, let's say, in November, in terms of offering a signal or giving a guideline to the Bank of Canada? Let's suppose, go back to Terry's employment numbers. Let's suppose we get a really lousy US employment report next week, and perhaps there's even some downward revisions to the previous month's payroll figures. Would the Bank of Canada still feel comfortable about going on with its own tapering if Canada's economic numbers begin to improve, or would they feel, well, perhaps we should be waiting to see whether or not the Fed's going to taper, or indeed wait until they do taper? How independent is the Bank of Canada going to be, from the Fed?
Well, as long as they think financial markets are calm, they could do something different than what the Fed's doing. But I think they'll be always watching how things go in the States, because the two economies are so interlocked,
Mm-hmm.
and also the sentiment and expectations, not just among businesses, but mostly in the markets. If they detect any danger of tapering faster or slower, then they might adjust. But again, it's probably up to the data, both north and south of the border.
Okay, excellent. Thanks for that, Max.
Thank you.
Right, well, let's round off this podcast then with my part of the world in Europe. And I guess the main thing to say here at the moment is that there's going to be a number of not particularly happy bunnies sitting around the ECB. As folks probably remember, we've seen the European Central Bank increasing its asset purchases, its quantitative easing purchases back from March time, when it's getting concerned about what was then a rapid increase in longer dated sovereign debt yields. It did decide at the last meeting to actually unwind some of that increase, but since then, courtesy in large part of what's been happening to the US Treasury market, the likes of German bonds now are trading, well, the best part of 10, 12 basis points or so above where they were at the time of the March ECB meeting, when they decided to increase their purchases under their pandemic emergency purchase program. So since policy, as far as the ECB is concerned at the moment, is all about trying to maintain favorable financing conditions, looking at what's going on in the bond markets is not going to put too many smiley faces around the governing council. Now, as far as the economic data coming out of Europe, if anything, they certainly don't justify any kind of tightening of monetary policy, or at least a less loose monetary policy. On Friday, we'll get, as Brian was talking about, we'll get the first round of the PMIs out of Europe as well. Excuse me. They're expected to show a further loss of momentum. Now, if we look at the third quarter average for the PMI Composite Output Index, if the market consensus is right from our Econoday calendar, then we're talking about probably about 58.4 after 57.9 in the second quarter. So on the face of it, some kind of pickup in economic activity. But that masks what would be a fairly sharp deceleration in terms of both the August and the September data. Already now, for some time, we've seen problems in the auto sector, as Max was talking about, this semiconductor issue, which is clearly a worldwide problem at the moment, where it's been particularly an instrumental problem as far as German auto industry is concerned. And indeed, it's got to the stage now whereby we're seeing that the supply chain issues there are hitting demand too. Quite simply, the car producers can't get enough of these semiconductors to make the cars, which is leading to a reduction in demand for other products which go into the manufacturing. So it's starting to actually hit demand as well. Indeed, new EU car registrations are heavily negative in terms of year-on-year growth rates in August, and that's in terms of Germany, France, all the major European countries anyway. And that's the second consecutive month we've actually seen negative growth there, having seen positive growth every month since February previously. So it looks like the way demand is shaping up as a whole, it does seem to be, well, not say deteriorating, but certainly the growth rates are slowing down at a time when most of the forecasters were looking for a fairly respectable third quarter growth number. The Europe's lorry driver crisis, that really continues to deepen. There's a massive shortage of HGV drivers on continental Europe, even more so as far as the UK is concerned. And from the latest coming out of some of these haulage organisations, that's now expected to run probably into at least the first half of next year. So there are a lot of factors at the moment. Obviously, take this on board with what's going on with fuel prices in general, which really is posing something of a threat to the European growth outlook. Now, the problem, of course, for ECB is inflation, along with most of the rest of the world at the moment. And we'll get the flash September HICP data, their official inflation numbers out on Friday. And they're expected to show another pickup in the headline rate up to about 3.3% from 3.0%. That would be its highest reading since September 2009. And the core rate up at 1.8%. If that calls right, well, that would equal its highest reading since December 2008. So there's certainly pressure from the pipeline prices side, and indeed the headline inflation rates on the ECB, to really start to tapering. But of course, the real side numbers are arguing the other way. And I guess the key point, one of the main comments coming out from ECB President Lagarde today, was that she still sees the risk to inflation as being greater for a sub 2% reading over a medium to longer term than it is being above a 2% reading. So in other words, as far as Lagarde's concerned, they still see downside risk to inflation, and hence no justification whatsoever to start playing around with policy. Something I should also mention with regards to Europe more generally, from Germany, the election there we saw on Sunday, that was much closer than expected. And it's really effectively less something of a stalemate, which means either the centre-right or the centre-left could create the new government. Negotiations going to run on probably at least until the end of this year. They're talking about Christmas time as being the target date to actually get the new administration in place. But if the last election back in 2017 is anything to go by, it took them 6 months to form the what was the Grand Alliance then. Now, what comes out of this will be important, because probably from the end of October, they'll be starting across the European Union new negotiations surrounding the Growth and Stability Pact. And this is the EU-wide agreement which lays down the fiscal rules. So essentially how much public sector borrowing and how much debt the various nations, and indeed the EU as a whole, is actually allowed to undertake. Now, currently we have a relatively strict 3% deficit to GDP ceiling and a 60% debt to GDP ceiling under the old Maastricht Treaty, the criteria laid down to actually enter the single European currency. Now, those criteria have been suspended during the COVID crisis, but as and when they come back, the question is what they're going to look like. And these talks beginning probably the end of next month are supposed to determine what the new levels are going to be. If we see a socialist swing or a swing to the left coming through in Germany, given the clout of Germany, that could have a major say in terms of what fiscal policy is going to look like, not just in the Eurozone's biggest member state, but also for the rest of the region as well. UK then, well, there's nothing out the Bank of England last week in terms of interest rates. There was a unanimous 9-0 vote for no change there, which came as no surprise to anyone. But the ceiling on quantitative easing, the current 895 billion sterling pounds, there's a couple of voters there who wanted to see an immediate end, at least, well, effectively a reduction in the ceiling, which would mean that quantitative easing would come to its conclusion as of now. Now, from most of the talk coming out from the minutes and since we've actually had that meeting, it does seem as if the bank is gradually shifting in the direction of, well, look, we've been saying that inflation is going to be short-lived and is going to come back down to target. Now it seems they're not quite so sure. That's not to say that interest rates are about to go up, but bear in mind, as far as the Bank of England's policy is concerned with regards to exiting the current state of affairs, they see interest rates going up before we actually start to see any kind of reduction in quantitative easing. So it's going to be bank rate will be the thing to keep an eye on. There has been some talk we could see bank rate being increased before the end of this year, which personally I think is still unlikely at this stage. But if we continue to see extremely high inflation numbers, and recently they've been well above expectations as we move into the next MPC meeting in November time, the markets I suspect are going to be increasingly nervous. That could actually lead to rates going up a good deal faster than currently discounted. Okay, I guess that's probably the quick wrap up from my side of the world. Anybody else have anything else they'd like to say before we wrap this thing up?
Nothing from the US.
That's one. Brian, Max, happy?
Yeah, all good here. Thank you.
Yeah, sounds
If we
good.
ever can be happy in this troubled world. Okay, then that is it. Let's wrap it up there then. Well, I guess from mid-May until early last week, central banks have made a pretty good job of convincing investors that rising inflation will be only short-lived. But it may be now that markets either need additional reassurance or even less accommodative policy stances to prevent the current increase in yields from getting out of hand. So hang on to your hats because it could be a volatile time ahead. Either way, the smart investor will want to keep up to date with all the latest key data and events, which of course can be found detailed and analysed in Econoday's global economic calendar. On behalf of Terry, Brian, Max and myself, thanks as always for listening, and the podcast will be back again next week. We'll see you then.